Right, Lamai, from this video, we will discuss question number 191 onwards. Okay, right, paper 6. Still we are discussing paper 6. Paper 6, question number 191. Right, look at the question. Look at the question. Right. State whether the following statements are true or false in accordance with the Sri Lanka accounting standards. True or false? Right. Look at the first one. A. Determining the accounting policies of an organization is always done at the discretion of the management. No, it is false. False. Okay. It is false. Not always. Accounting standards provide guidelines for accounting policies, but if there is no specific accounting policies, business organization management can decide accounting policy based on their best judgment. Okay, A false. Look at the B. Look at the B. A provision is a liability with no specific amount or specific time. Provision is a liability. Amount and time is uncertain. We can't say it has no specific amount. We can't say it has no specific amount. There is some amount, but that value is uncertain. We can guess the time, but the time is uncertain. No specific amount and specific time is false. Now my second one false. False, huh? B false. B false. Right. Look at the C. Changes in accounting estimates of an entity are adjusted to the present and future financial statements. Yes, changes in estimates adjust to present and future financial information statement. Okay, prospective adjustment. Prospective adjustment. Retrospective means we need to adjust from the past. Okay, retrospective adjustments applicable for the policies, but for the estimates, present and future financial statements adjust if there is some change in accounting estimate. Right. D. Contingent liabilities. Yes, C true. C true. C2, right. D. Contingent liabilities are not recognized in financial statements of an entity. Yes, that is true. D true. Right. Not recognized, but we need to include some note regarding contingent liability. Right, 191. Right, students, go to 192. Look at the 192. Look at the question 192 and get the answer. 192. Right, what is the answer for the 192? Fine. 192. State whether each of the following items is a cash flow generated from operating activities or not. A cash flow belongs to operating activities or not. Okay, right. A. Employee salaries paid. Yes or no? Operating activities or not? Yes, operating activities. Depreciation? No. Depreciation non-cash flow item. No, not belongs to operating activities. Tax expenses? Not belongs. Why? We record only tax paid. We record only tax paid. So tax expense? No. Interest paid? Yes. We ignore interest expenses, but we add but we deduct interest paid. Okay, when you're calculating operating activities, you need to add back interest expenses. When you calculating operating activities in direct method, interest expense plus to the profit before tax, and then interest paid you need to deduct. Interest paid, yes. Then it has employee salary, yes. Depreciation, no. Tax paid, tax expense, no. Interest paid, yes. Right. Look at the question number 193. Look at the question number 193. Right. The capital of Avanta Public Limited as at 1st April 21 was 1,500,000 and the share price is 50 rupees. Share price is 50 rupees. On 1st October 21, reserves were capitalized as 1 for each of 3 shares. And on 1st January 22, right issue was made as 1 for 2 ordinary shares. And all the shares were sold. A number of shares held as at 1st April 21. Right, Kamai? Please hold the video and then try to get the answer for this question. And after that, watch the video. Right, 193. We'll discuss. A number of shares held as at 1st April 21. Number of shares. How to calculate number of shares? The total share capital is 1,500,000 rupees divided by price of a share 50. Price of a share 50. Number of shares. 1,500,000 divided by 50. 30,000 shares. Answer for the A, 30,000 shares. 30,000 shares. Answer for the B. The balance of the ordinary shares capital as at 31st March 2022. The balance of the ordinary share capital. Right. Let's see ordinary share account. Ordinary share account. Opening balance 1,500,000. Opening balance 1,500,000. And then reserve capitalization 1st October 2021. Reserve capitalization 1 for each of 3 shares. Number of shares 30. 30 divided by 3 into 1. 1 for each of 3 shares. Then, okay, 30,000 divided by 3 into 1. 1 for each of 3 shares. Held on first and right. And then now issue price is what? Bonus shares, reserve capitalization, bonus shares. Issue price, we have to get issue price as 50 rupees. 50 rupees. 50 rupees. Reserve capitalization. How much? 30,000 divided by 3 into 1 into 50, 500,000. 500,000. Reserve capitalization 500,000. Okay, yeah. Retained earnings debit. Ordinary share account credit. Reserve capitalization 500,000. Reserve capitalization 500,000. 500,000. And then students, on 1st October 22, on 1st January 2022, they have issued right issue was made as 1 for 2 ordinary shares. On this day, number of shares, right, what about the number of shares on this day? Opening number of shares 30,000. Opening number of shares 30,000. And then based on the reserve capitalization, they have issued 10,000 shares. Based on reserve capitalization, they have issued 10,000 shares. 10,000 shares. 10,000 shares. Then students, number of shares 10,000. Number of shares 10,000. 30,000 divided by 3 into 1. 30,000. 10,000. So then, number of shares as at 1st January 22, 40,000. 40,000 number of shares. And then here, reserve right issue is 1 for 2 ordinary shares. 1 for 2 ordinary shares. Then 40,000 divided by 2 into 1. 1 for 2 ordinary shares. It means 20,000. They have issued 20,000 ordinary shares. They have issued 20,000 ordinary shares. 20,000 ordinary shares. And then here also, issue price is missing. Issue price is missing. Therefore, we will take issue price as 50 rupees. 50 rupees. Then 20,000 into 50 rupees. 20,000 into 50 rupees. 1 million. 1 million. Right issue 1 million. Then right issue 1 million. Cash book debit. Ordinary share account credit. Right issue. Cash book debit. Ordinary share account credit 1 million. Then total capital asset. Total ordinary share capital asset 31st March 22. Total ordinary share capital. Here 2 million, 3 million. 3 million. 3 million. Total ordinary shares capital 3 million. Answer for the B. Answer for the B 3 million. Answer for the B 3 million. 3 million. C. Look at the C. Look at the C. The increase or decrease of equity. Total equity increased by 1 million. Reserve capitalization. Because of reserve capitalization, no impact to equity. Retained earnings debit. Ordinary shares credit. No impact to equity. Here, answer for the C. Increase or decrease equity as of 31st March. Increase in equity. Increase in equity 1 million rupees. Increase in equity 1 million rupees. Increase in equity 1 million rupees. And then increase of cash balance as of 31st March 22. Increase of cash balance. How much? 1 million rupees. 1 million rupees. They have issued 1 million shares. Okay, 1 million shares. On that, they have collected 1 million rupees. Cash book debit 1 million, ordinary share account credit 1 million. Increase in cash 1 million. 1 million. Right, students. That is the answer for the question number 193. Answer for the question number 193. Right. 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 And then students, look at the next question. Use the following information. Use the information below to answer the question number right. Here 194, 195. Look at the next question. Students, if you want this paper, please send me a message to my dialog number or model number. Then I will send you the paper. Right. Use the following information to provide answer for the, it should be 194 and 195. Right. Then here, following information has been extracted from the statement of changes in equity of Luxury Limited. Closing balances and opening balances. Closing balances, ordinary share capital, general reserve, revaluation reserve, retained earnings. Right. Right. And then students, dividend paid during the year 300,000 and income tax expense 200. The land which had recorded a loss of 200,000 in previous year has been revalued during the year. The increase in share capital during the year was occurred due to capitalization of retained earnings. Increase in share capital during the year was occurred due to capitalization of retained earnings. Right. Okay, right. 194. First one. What is the profit for the period for the year ended 31st March 22? Profit for the period. Next one. What is the amount of other comprehensive income earned for the year ended 31st March 22? Right. Answer for the question 94. Try to get the answer for the 194. Right. Right. 194. So the question again. What is the profit for the period? Right. profit for the period for the year, right? And then what is the amount of other term, right? Profit for the period we can calculate through the retained earnings account. Retained earnings account 194. Retained earnings account. Retained earnings opening balance how much? Retained earnings opening balance 1,600. Retained earnings closing balance 2,600. Opening balance and closing balance. Retained earnings. Now additional information. Dividend paid during the year 300. Dividend paid during the year 300. Cash book credit. Retained earnings account debit. Dividend paid 300. Dividend paid 300. Dividend paid. Income tax expense 200. Right. You can calculate profit before tax using income tax. The land which had recorded a loss of 200 in previous year has been revalued during the year. Right. Okay. Okay. Right. Right. Anyway, revaluation reserve increased by 500 rupees. 500 rupees. The definitive total revaluation gain is 700 rupees. 700 rupees. Okay. Right. See, the increase in share capital during the year was occurred due to capitalization of retained earnings. From retained earnings, they have issued bonus shares. Capitalization of reserves. Now, from retained earnings, they have removed 1,000 rupees and they have issued shares. They have issued shares. 1,000 shares. Holding share capital increased by 1,000. So then, my retained earnings debit 1,000. Holding shares. Holding share capital credit 1,000. Holding share capital credit 1,000. Right, done, finished. Right, now you can balance the retained earnings account and calculate the profit for the period. 1,000 plus 300 plus 2,600, 3,900, 3,900, 3,900 minus 1,600. Now I 2,300 profit for the period. Profit for the period 2,300. Answer for the question number 194 1. 194 1. 2,300 is answer. Profit for the period 2,300. Next one. What is the amount of other comprehensive income earned for the year ended 31st March 22? Other comprehensive income. Lamai 194. Answer for the first one. Answer for the second one. Here, revaluation reserve. Revaluation reserve. Opening balance 1,000. Closing balance 1,500. Closing balance 1,500. It means they have credited 500 to revaluation reserve. Last year, there is a loss of 200. Then after recording, after reversing that 200 to other expenses, they have recorded 500 in the revaluation reserve account. And then in this year, on other comprehensive income, you need to record 500 rupees. Then total revaluation reserve how much? Total increase in revaluation amount how much? 700. Revaluation reserve total increase by 700. But out of 700, 200 charged to other income, other expenses. Balance 500 charged to other comprehensive income. Then, and other comprehensive income, what is the amount of other comprehensive income earned during the year? 500 rupees. 500 rupees. Other comprehensive income, 500 rupees. Who's here? 500 rupees. Right, 194 done. 194 done. Now, if I look at the 195. 195. Balance part of the question, 195. Write the following values to be recorded in the statement of cash flows for the year 31st March 22. Values to be recorded, right? Net profit before tax. Profit before tax. Lamai, profit for the period 2,300. Answer for the 195. 195. Profit for the period 2,300 plus income tax. Income tax expense how much? 200. 200. 195 first one answer. 2,500. 2,500. Surplus or deficit generated through land revaluation. Surplus or deficit generated through land revaluation. Surplus because of land revaluation. Surplus is how much? 700 rupees. 500 plus 200, 700 rupees. 700 rupees. Land revaluation surplus. 700 rupees. 500 plus 200 surplus. Okay, surplus, total surplus 700 rupees. Right, 195 is over. Right, now I look at the question number 196. Right, 196. State whether the following statements are true or false. True or false. Now 196.1a. When an inventory is borrowed, the current ratio increases. False. Right, now I get the answer for the 196. We will get the answer as false. I will give you the reason. Look at the 196. Look at the 196. Now I look at the 196. 196a. A, when an inventory is borrowed. Borrowed means when you obtain an inventory on credit basis, the current ratio increases. Right, am I? Current ratio acceptable proportion is current assets to current liability 1. Here they have not given. In this paper, they have not given the ratio. Existing ratio, they have not given. But acceptable ratio is 2:1. 2:1. 2:1. Then here ratio is 2 divided by 1, 2. 2 is the ratio. But when if they borrowed inventory, let's say current assets 200, current liability is 100. This is the ratio. Let's say if they borrowed 50 stocks on credit basis, then what will happen? Stock will increase by 50, current liability will increase by 50. Then current assets 250, current liability 150. Now the current ratio, 250 divided by 150. 250 divided by 150, current ratio, 250 divided by 150, 1.67. 1.67. Current ratio decreased. Current ratio decreased. But here current ratio increases. False. False. Here false. A false. 196 A false. Here current ratio decreased. Decreased. In this question, that is false. Look at the transaction number B. Right. When debtors turnover decreases, the debt collection period also decreases. When debtor turnover decrease, debt collection period decrease or increase? Increase. Debt collection period increase. This is false. B false. B false. Calculate the debtor turnover ratio and divide by 365. Then you can get the answer. Try to get the logical answer. Don't cram this point. Easy question. Easy question. Debtor turnover lama here 196B. 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 Let's say data turnover ratio. Let's say data turnover ratio 10 times. 10 times. And then let's say 20 times. 20 times. Data turnover ratio. Turnover ratio. Let's say next turnover ratio 6 times. 6 times. Then 365 divided by 20. Okay, debt collection period. Debt collection period. 365 divided by 20. 18.25 days. 18.25 days. Debt collection period. It means okay, every 18 days they can okay, in each 18.25 days they can reach to 0 level of data. They can collect from data. If debt collection period, if data turnover ratio decrease, what will happen? 365 divided by 6, what will happen? 365 divided by 6, 60.80. If data turnover ratio decrease, what will happen? Debt collection period will increase. Debt collection period will increase. B false. When debtors turnover decrease, the debt collection period also decrease. That is false. That is false. Right, now I see. The higher interest coverage ratio shows the higher ability of paying loans and interest by the business. Yes, that is true. That is true. True, true. See, true. The increase in debt equity ratio is desirable for a company. True or false? False. False. Calculate debt equity ratio. Here, increase in debt equity ratio and calculate low debt equity ratio and higher debt equity ratio, and you can compare. Okay, desirable for the company. False. 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 196. Right. Last few questions. 197. Well, look at the 197. Name the documents involved in the following steps in process of purchasing material in a manufacturing company. What are the relevant documents? Try to get the answer. We'll discuss. Requesting from purchasing department to purchase material. Requesting from purchasing issuance of the warehouse is a request. Request from purchasing department to purchase material. Purchase equation not. We don't have stock, therefore place purchase. Purchase equation not. Second one, requesting material from the stock by the production department. Requesting material from the stock by the production department. Material equation. Material equation not. 3. Confirmation of receipt of material into warehouse. Confirmation of receipt of material into warehouse versus also given. Good received not. GRN. Good received not. Fourth one, informing the supplier to supply goods versus also given. Informing the supplier to supply goods versus also given. Purchase order. Purchase order. Purchase order is also given. Right. Lamai. Question number 190. Name the two main types of records used by a used to record labor type. Time keeping reports and time booking reports. Check the management account lesson. Labor costing. Time keeping reports and time booking reports. Right. 199. In a manufacturing business, the unit selling price is 200. Unit variable cost is 80. Fixed cost 360. Expected number of production unit is 5,000. Calculate the break-even units. Right. Now I get the answer. Try to get the answer for the 199. Right. First one, calculate the break-even sales. Break-even units. Break-even units. Now I how to calculate break-even units? Fixed cost divided by contribution. 360,000 divided by contribution. Here, contribution how much? 200 minus 80, 120. 120. Break-even units, students. 360,000 divided by 120, 3,000 units. 3,000 units. Right. Second one. Calculate the value of margin of safety. Calculate the value of margin of safety. Value. My margin of safety units. Here expected production 5,000. 5,000 minus 3,000, 2,000. Margin of safety units, but to calculate value, multiplied by 200. Multiplied by 200. Then how much the margin of safety in value? 400,000. Answer is 400,000. Answer is 400,000. Okay, right. 199. Lamai. Right. 200. Question number 200. Right, Lamai. Look at the question number 200. Last question of this recording. And after that, we can move into another paper. Paper number 7. Already I have given you. If you want the paper number 7, please send me a message. I will send you. Right. 50. Look at the Question number 200, right? A company is considered to purchase a machine for 3 million. Purchase price of the machine 3 million. Purchase price of the machine 3 million. Scrap value 500,000 and the useful lifetime is 5 years. Net cash flows 1,200 per annum is expected to be generated in each year. Calculate the payback period. Now, my payback period. Question number 200. Try to get the answer. Right, payback period. Now, my payback period. The payback. How to calculate payback period here? Initial investment divided by annual cash flows. Here, net cash flows of 1,200 per annum. Then I 1,300,000 divided by 3 million divided by 1,200,000. 1,200,000. Payback period. 2.5 years. 2.5 years. 2.5 years. 2 years and 6 months. Second one, calculate the accounting rate of return. Now here payback period is 3 million divided by 1,200,000. Then 2.5 years payback period. 2.5 years. And second one is calculate the accounting rate of ARR. Calculate the ARR. ARR. How to calculate ARR? How to calculate ARR? Average investment divided by average profit. Accounting rate of return. Sorry, average profit divided by average investment. Average profit divided by average investment. How to calculate average investment? Average profit. Average profit. Average profit divided by average investment. Average profit here in this question. Annual cash flow 1,200,000. 1,200,000. 1,200,000 into 5 years. Total cash flows how much? 1,200,000 into 5 years. 6,000. 6 million total cash flow. And then you can add annual depreciation. We will add depreciable amount. Depreciable amount. Value of the machine 300,000. 300,000 minus scrap value 500,000. Depreciable amount 2,500. Depreciable amount 2,500. 2,500 depreciable amount. Then annual cash flows. To calculate total profit 6,000 minus depreciable amount. Depreciable amount. Then 6,000 minus depreciable total depreciable amount 2,500. Then 3,500. Total profit for 5 years 3,500. 3,500 divided by 5 years. Annual average profit. Annual average profit. Annual average profit 700. Annual average profit 700. 700 divided by average investment. How to calculate average investment? Average investment. Initial investment plus scrap value divided by 2. Divided by 2. Average investment. Average investment 1,070 into 100. Then ARR is 700 divided by 1,750 into 100. 40%. ARR 40%. ARR 40%. Right, now then payback period 2.5 years. Accounting rate of return on average investment 40%. Right, 40%. Right, now that is the end of that video. Question number 201 onwards we'll discuss from the next video. Okay. And from the next video onwards we'll start paper number 7. Right. Thank you.